All right, a very good evening to every one of you today. Happy to see everyone again tonight. I'm Mei Ting here from Investing Note and I'll be your host tonight. So tonight's topic will be very interesting also because we are embracing the for inflation and also recession, and with a team of helping us to build a defensive portfolio with two of our speakers tonight, Mr. Raphael from CSOP and Dr. T, the founder of EIN55. So I think we are going to starting very soon for this webinar. So please note that this webinar also being live streamed into our Investing Note Malaysia Facebook page. So if you have friends who are interested to know more about this, do help to share out and also invite them to come into our webinar tonight, as we have two of our speakers here to help you if you have any question regarding the market right now. Okay, well, I think it's been a very bumpy week for this week's stock market. And last night, we just got the latest CPI index rising like 8.5% in July. So it is actually less than expected and lowered compared to an increase of 9.1% in June. So this actually makes a lot of the investors, right, to think that inflation might be at a peak. And earlier on, we had a mixed data whereby the initial jobless claim climbed a little bit, and comparing to the previous week, while both of the unemployment rate and also on-farm payrolls actually show some strengths like in the labor force, which actually contradicts the concept of recession is coming. So is it like recession or inflation is happening? Well, tonight's topic will be the embracing for inflation and recession. So yeah, we have invited two of our speakers tonight, Dr. T and also Mr. Raphael. So we'll be starting our webinar very soon. But please allow me to introduce you the Sjx Telegram. So you can see in these slides, right, we have two big QR codes at here. One is the Sjx Telegram, the other one is Sjx E-Newsletter. So both of these channels, right, will actually get you into if we are investors, like you will be the first few to get the daily market reports, research on Singapore stocks, and also latest macro factors, which actually will affect the specific Singapore stock, and also some fresh updates every day. So do take out your phone and just scan on these two QR codes to join our Telegram to learn together. And also the next one is the Sjx E-Newsletter. So this is actually a compilation of the latest market news, including sector performance, new product release updates, and also research report from the Sjx listed company. So this e-newsletter also includes the upcoming events, programs, seminars, whereby it's perfect for you to actually learn new things, especially if you are interested in the Singapore market, and also seminar, courses, invitation organized by Sjx and also industry partners. So heads up to Sjx and wait no more, just take out your smartphone to scan on these two QR codes, as you wouldn't really want to miss this opportunity to get more insights. Yeah. So all right, so let me introduce two of our honorable speakers tonight. So Raphael will be our first speaker. He is from CSOP Asset Management. Raphael actually oversees the ETF investment solutions for brokers in Singapore, and he is also part of the team responsible to develop sales strategy and a strategic partnership with intermediaries in Singapore. So next we have Dr. T. Dr. T has also been our speakers before. So if you join our previous webinar, you definitely are familiar with him. Okay, so he's the founder of EIN55 investing blog. He also shared his experience with over 800 investment articles, conducting over 200 investing seminars using fundamental analysis, technical analysis, and also methods with unique EIN55 Optimism strategy. So I can't wait to actually learn from both of our speakers' sharings tonight. So if you have friends who haven't tuned in, it's the time to remind them, as this webinar will be broadcasted live, also live in Investing Note Malaysia Facebook page, and we'll be starting right now. So participants, if you have any question would like to ask the speakers tonight, do drop the question in the Q&A box, and we'll be having a Q&A session later. All right, so without further ado, let's welcome the first speaker tonight, Mr. Raphael. So he will be talking about most likely talking about the riding through volatile times. So he will bring you through like what's happening on the stock market right now, from the US inflation, Russia-Ukraine wars. Then we'll be having a huge drawdowns in first half of 2022. So welcome, Raphael. Over to you.
All right. All right. Big thank you to Investing Note and Dr. C. It's my honor to be here tonight, and all of you lovely guests, audiences that is tuning into this. Thank you for spending your this lovely evening with us. All right. So today's topic we'll be covering would be bracing for inflation and recession and building a defensive portfolio. All right. So just a disclaimer on today's topic. All right, so let us go through a market recap for the first half of 2022. So most of us, we have invested in global equities and all. We would likely will feel some pain at this juncture. All right, so what has actually happened for US side, inflation numbers are actually pretty much drastic, but luckily last night, as investing note meeting I shared earlier on, it luckily came down a bit, and it's came down much more than as expected. So I think that is some sign of relief for most of us investors here. So with that in mind, all right. So this year, US had a unprecedented interest rate hike. We saw it being one of the highest in multi-decades, with a 0.75 percentage point, or rather 75 basis point in June and July 2022. This was the largest increase since 1994. Okay, so with this in mind, the Fed Reserve itself, they are committed to bring inflation figures down, and what this means to the market is that with a higher interest rate environment, it will be costlier for business to operate. And with this, currently we are in unprecedented and volatile times with the ongoing Russia and Ukraine conflict. And for China itself, it seems that COVID isn't stopping anytime soon. You see it on and off, all this uh, lockdowns happening here and then. And currently, the U.S. and China tension, geopolitical tensions also seem to uh, be of concern to most investors like you and I. And these days, we really see how volatile the market it is, and what's the road ahead of us if, let's say, we were to invest. All right, so allow me to recap. So building a defensive portfolio, as REITs itself serves as a good defensive hedge for most portfolio. Just allow me to share this chart with you guys. Year to date, we saw sharp declines over global indices due to all these high interest rate, high inflation figures, global uncertainties, and all. And from that, we can see that you have your Hang Seng Index dipping close to 14%, and your Nasdaq and your S&P 500 both themselves declined over 18 and 40% respectively. But meanwhile, the Ihs Leaders Index itself is maintained relatively stable. So in such an environment where we see global uncertainties and market volatility, it is always good to diversify and keep track on what are some of these uh, alternate investments that in the market itself that allows you to hedge against all these high volatility period. All right, so allow me to touch on about inflation and the interest rate environment. As we all know, high inflation recently became a concern to most investors like you and I. So what does high inflation mean for REITs itself? All right, so for REITs itself, generally means that operating costs will be higher. You will have higher utility charges, and this may impact negatively towards the operating margins of these REITs, and may in turn affect the dividend per unit for REITs itself as well. But not to worry, for REITs itself, I think for most investors, try to look out for asset class that can pass through this higher inflation. So what do I mean by passing through this high inflation? So for instance, retailers themselves are a good example. So why is it so? They are able to pass all this high inflation towards consumers because they are able to adjust prices more rapidly, and this in turns will allow uh, subsequently retail rents to benefit from all these price adjustments. All right, so yes, higher interest rate may negatively impact REITs itself due to its like I mentioned earlier on, the higher cost of borrowing and negative sentiments. But I think for most investors like you and I think that the thing is to keep track and take note that short shorter term interest rates rise much faster than the longer tenure ones. So overall, which is why in uncertain markets, REITs are often viewed as defensive strategies because their rental income are usually secured due to the longer leases. All right, as I mentioned earlier on, S-REIT can act as good hedge against inflation risk because why? First off, rent itself, it's also a composition of the consumer price index. So when in a higher inflation environment, it may often lead to higher rents as well. So for the S-REITs, based on this uh, estimates by JLP, dividend yield is expected to rise over the next 2 years and higher than the average Singapore inflation rate. Now moving on to sector outlook. As mentioned earlier, all these rate hikes have been unprecedented, and we saw all these higher hikes in decades, and this may often trigger to higher, I think, um, higher costs for certain REITs. So things for investors to take note is to avoid REITs with higher gearing um, and floating debt. I think for most investors right now, the key portion is to keep a lookout for REITs that are of value, meaning to say you can look at their financial ratios and expense and also their debt to equity, and these are key figures to keep a lookout for um, in order to invest in all these value REITs. So for the occupancy wise, we saw a increase in occupancy over the past 2 years for REITs itself. And for warehouse occupancy wise, we are currently looking at over 90% increase in the or rather 90% occupancy for warehouses. And for business park, occupancy rate is also well over 85%. So with all this opening of the economy, we can see that all these demand for office rentals have been coming in, and over the next few years when the economy generally opens up even more, we will likely to see more and more of all this demand for all these office, hospitality, warehouse and all. All right, so recovery, hospitality is recovering. As we can see, tourist arrivals, as we Singapore has just lifted its tourism sector, tourist, uh, which allows tourists to come into Singapore. And I think for this juncture, most investors should keep a lookout on um, investing in quality REITs and keep a lookout for retail as well, as increase in tourism will eventually affect all these retailers out there and bringing much more retail sales towards Singapore market, and then we will see subsequent increase in the retail REITs as well. All right, so what we can see over the past trend from the CBRE research is that basically CBRE themselves, they are the property researchers, so they have shown that current warehouse REITs are outpacing all the factory rents, and we saw that the demand for warehouses are constantly increasing and is set to increase over the next few years as well. So for industrial demand and limit for industrial demand, it also has been upkeeping. So there was a healthy rental, and while we see that currently there's a lack of supply in terms of industrial, which is why sad to say uh, for businesses they are renting out, they will have to face higher rents going forward, and this forecasted year-on-year increase of 8% based on the CBRE research. So for now, rental is still I think most most investors, rental is part of their. I would say that they are looking for rents to increase in their dividend payment in terms of their portfolio, and the sector is as such. Office space have been increasing over. Has seen a strong take up ever since the lifting of COVID restrictions. All right, so I shared earlier on the IH S-Street Leaders Index. So basically, this index itself comprises of 28 securities, and it focuses on industrial, office, retail, and multi-type of equity REITs. So the heaviest weightage is on industrial and warehouse. For the IH S-Street Leaders Index, right? Um, what is it so special about this methodology is because it is liquidity adjusted, meaning to say that they focuses on the large and mid caps as REITs that focus on that has highest transaction volume and traded velocity. And what this in turn means for investors like you and I is that, well, investors like you and I often, when we trade, we aren't able to move the market. More often than not, the institutions are the ones that move the market. And with a liquidity adjusted being one of its feature of this index, what this means for investors is that it will allow investors to participate in the current trend of what the institution buys or sells. It will be captured according on a daily traded basis, and it will be adjusted semi-annually. So for S-REITs, why should we look into an index rather than an individual counter alone? All right. So for as the index itself, it provides or it allows investors like you and I to have access to both cyclical and defensive themes, and it allows investors like you and I to mitigate our portfolio risk uh, uh, with the diversification than to hold one or two or a few names. This will reduce the overall portfolio volatility and the maximum drawdown. And with being focused on the large and mid caps as REITs, this will allow investors to gain better beta exposure to the market, as it is the index itself is dominated by the liquid large and mid caps as REITs. So why do large and mid cap as REITs tends to outperform the market? I think most uh, over the past decades that we observe, more often than not, all these large and mid cap as REITs tend to outperform the smaller ones, namely also because that these large to mid cap as REITs, they are usually government linked companies or government linked sponsors. They tend to hold quality and well located and dominant assets. And with this in mind, they tend to have a larger global outreach, and they will have potential for higher debt room, meaning to say they can take on higher debt for the acquisition. And also, the trend that we have been seeing over the past few months is that all these large and mid cap S REITs, they have been going overseas to acquire properties, acquire all these warehouses, and to expand their business, and this will allow them to scale up rapidly and compete against uh, global peers itself, and it will allow investors to gain uh, a diversified geographic exposure, and also allow greater trading liquidity, which access to a wider pool of investors. As mentioned earlier on, the IHS REITs Leaders Index itself is rebalance based on liquidity. So when all this liquidity is being factored in, what this means is that every time it rebalances, investors will be participating in the current trend of the current markets. For instance, let's say over a time period of time, previously the index itself focuses on industrial. And next up, over this period of time where it's being assessed on a daily traded basis, we realize that institutions have been moving their funds out of industrial towards hospitality, towards other form of sectors. Be sure that during the next rebalance, it will be considered and the index itself will be rebalanced accordingly. So the IHS Reits Index itself has the highest yield compared to the other options. The forecasted yield for the IHS Reits Leaders Index is at 5.6%, while the average yield for STI Index is around 4.4%, while MAS core inflation rate is at 3.6%, and the MAS government 10-year bond is at 2.8%, while the fixed D rate is at 1.6%. So in my earlier slide, like I've shared how the index itself fared against its global indices when the negative news hit. I think for most investors like you and I, we would want a certain form of certainty in such uncertain markets, and that with this in mind, we can be safe to say that the IHS Leaders Index is actually pretty much resilient compared when it's being hit by negative news. All right, so for the key takeaway, all this is that just keep a lookout for quality REITs at this current juncture. Do not go for REITs that overgear themselves, or they have for instance, just keep a lookout for their financials and be more mindful in such an environment where interest rate becomes is in a rising environment. Cost of borrowing tends to be higher, and that certain companies will have troubles paying off. So just keep a lookout for their financials in this current period. And mid-cap REITs itself allows higher yield and also a stable cash flow, and gives investors certain representation in the market that is not being offered by the large caps. All right, so last but not least, I just want to share that who is CSOP? CSOP Asset Management is basically an asset management company that was established in Hong Kong in 2008. Right, so for us, currently our total AUM is about 12 billion US dollars. We are more famous for is that we are ETF provider. So we have 37 ETF listed across Hong Kong and Singapore, and 3 mutual funds. So with this in mind, I think I'll pass my time to Dr. T.
All right. Thank you so much, Mr. Raphael, for your sharing. So let me pull up my screen. Okay, so thank you so much for your sharing. It's quite an interesting point of view to look into the index rather than you say that allocating to a whole lump sum into a certain stocks, which can actually help the investors to diversify, and also I think is to better lower their portfolio risk. Yeah. So thank you so much, Mr. Raphael. So participants, if you have any questions, please do drop into the Q&A box. So after Dr. T's sharing, we'll be having a Q&A session to answer all of your questions. All right. So thank you, Mr. Raphael. So next up, we'll be having Dr. T to be sharing with us some of the notable defensive giant stocks. So Dr. T, he will break down the stocks and also 4 gigantic stocks, and also discuss on the technical and fundamental analysis on these 4 stocks. Yep. So over to you, Dr. T. Dr. T, you have to unmute yourself.
Yes, do a simple setup here. Yeah, while I'm presenting, actually, all of you can feel free to type your questions. At the end, Raphael and myself, all right, would actually do a Q&A. All right, should be fine over here.
All right. Yeah.
Okay, thank you. This is Dr. T here. I would like to share today's topic about how to actually form a defensive stock portfolio, mainly through like Singapore Reits and the dividend stocks, which are more defensive in nature. Because currently we know globally we are afraid all kinds of black swans. Wow, high inflation. Wow, interest rate keep on going up. Are you Russian, Ukraine? You don't know how long you'll fight, for another few more years, and then who knows later on what if China, Taiwan, another new, possible issues may come out. Yeah, so we worry. The market up, down, up, down, up, down. All right, so that's why some of you, so worry until dare not invest at all. That's why a few asking, Dr. T, should we buy low? Right, because we worry buy low may get lower. Or Dr. T, should we wait for recovery? But when you recover, then you say, sayang, why we do not want to actually buy, when it was low. Of course, if you know you will recover, definitely you will buy earlier. But the question is, no one know the future. Exactly, that is the nature of the stock market. Stock market is forward-looking, right? For example, last night we know that the inflation start to drop from 9.1% to all the way to 8.5%. But this is just a monthly trend. It doesn't mean anything at all, right? Who knows? Next month it could actually recover to another new high, right? But this is at least, right? I would say the very first important signal. And current market actually is very tricky, right? Because you thought it may entering recession soon, but you know that Nasdaq officially back to a bull market, because a more traditional way to define bear or bull is when the market from the peak drop by 20% or more, then they say it's bear market. But if follow the same logic, right? From the lowest point roughly 1 or 2 months ago, right? Nasdaq has actually gone up over 20% so far. So, but Dr. T, so are we in a bull or bear? So later on, Dr. T will share with you, all right, the market outlook, right? And in fact, using Singapore as an example. And in fact, I've prepared 4 of these stocks, not only that, because they are just individual stocks, right? You need to be protected by a sector, like the earlier speaker talked about, right? The Reits Index, and you need to be protected by entire country. When the sky fall down, let's say there's a crash, there's a global financial crisis, right? Do you ask yourself, do you think your own country, right, would continue? Dr. T, of course, life still goes on. Then why you're so frightening? Dr. T, I cannot help it, because every time I check the share price fall down, I cannot help but feel frightening. So you're human. So perfectly, you're normal. Unfortunately, normal people cannot make big money in the stock market. Why? Because stock market is designed for abnormal person. I'm not saying that you have to be abnormal. I just say when it comes to investing or trading, you need to know about your personality. So later on, I will introduce 2 main strategies. One is called average up, one is called average down. And in fact, both can work perfectly with today our topic here on defensive portfolio. Okay, without further ado, let's start from here. Right, my subsequent presentation and all my sharing is for educational purpose. And Dr. T will share with you, right, the strategies, and you can make your own decision. Making your own decision is the most important, because no one would know the future, what happened tomorrow, 1 month, or 1 year from now. But if you can align the strategy to your unique personality, right, that will actually help you a lot. Yeah, for example, the last few months, right, if the market actually melt down, right, in US, in Malaysia, or so on, are you frightening? And if yes, why? Right, is it because you buy a lot of cyclical stock, right, and stock probably without fundamental and so on? So that's why today we are focusing on a portfolio of defensive giant stocks. Okay, and this is just a quick introduction of Dr. T. But actually a owner of this investing blog, Ein55.com. Feel free to drop by there. A lot of learning materials, learning video, right? You can learn further. But today, Dr. T specially prepared this special educational video here, live to share with you how to actually fight against the black swans mentioned earlier on. Huh? Okay, so for those who know me for the first time, let me actually give you some introduction of my styles. So technically, you need to look for a portfolio of stocks to form so-called some form of diversifications. It's like form a football team. Goalkeeper is for cash, but you cannot keep cash all the time because inflation will actually erode, your this cash value over time. So we need to form strikers, looking for capital gains. Midfielders looking for capital gains plus this dividend return. And more importantly, today our topics, defenders. A lot of people thought defenders are just for the dividend collection. Not quite true. In fact, today, the defenders or dividend stock or even Singapore Reits, they can be strikers as well. They can be midfielders, meaning you may also position them for the shorter term, not just on the long term. But of course, for shorter term, trend following is actually important. Huh? Okay, let's learn further from here. Okay, my style is very simple. Looking for giant. Giant, not necessarily the largest stock, but it has to be strong internally. Even a small cap can become a giant, but don't buy the giant as it is. Wait for the giant to fall down. For example, wait for the price correction. So in the last 6 months, globally, there's a significant correction. Nasdaq, this S&P dropped by over 20%. At the same time, Singapore, is still relatively stable. In fact, today looks like achieved another new high over 3,300 points. While regional market, including like Hong Kong and so on, although not today our focus, remains at the lower optimism. Huh? So it's a good news to see a giant fall down, but this is theoretically correct. Say Dr. T, I can actually buy low, sell high, but you buy low, you might get lower. So that's why better to wait for the giant to recover. You not need to let it wait until it recover to a new high or new peak, but it must form some form of a base. Okay, yeah. So it means the fear have to be fading. Yeah. So it looks like we are seeing that kind of possible light at the end of tunnel. So that's why some people want to plan for the bottom fishing. So what I can say so far is minimum, we got a midterm bottom fishing. You can look for it. Minimum, you can get it. But whether the long-term bottom fishing or the ocean deep fishing, that one, is still not clear at the moment. Yeah. So that's why whoever positioning a current market right now is more for the short term to medium term. But in order for you to all the time frames may be considered today, I especially prepare on that talk on defensive portfolio, meaning short term, medium term, long term, all may consider. Okay, yeah. So that's why that portfolio allow you to remove the fear, remove the uncertainty of the market up and down, because a lot of people thought must know exactly where's the low and high to make money. Right? I would say yes, if you have that kind of capability, that'll be good. But a lot of people, what they are lacking is the ability to take action to just buy and hold. Okay. All right, so later I'll show you various mechanisms to make money. So in short, looking for giants, not just one giant, a portfolio of defensive giants, and then I patiently wait for it to fall down. And you can apply either average down strategies, meaning using contrarian approach, or using average up strategies, meaning integrating with a trend following, integrate trading into investing. Okay, so this is Dr. T Optimism method. I've got 55 investing styles. This is one of them. Technically, you need to know a value. Once you know the intrinsic value, the price, the low and high, you can define using scale of 100% to 0%. You can buy when it's less than 25% optimism. You can hold it within 25 to 75% here. You can sell when it's above 75%, and then you can wait for correction again to buy low. So these are the cycles of actions. Everything, all the investment move in cycles, even Bitcoin, even bonds, even economic cycles, even your greed or fear, all move in cycles. Reason is very simple. You're human. Human got greed or fear, right? So they will take turn, right, to actually create this kind of a low and high patterns. And you have different personalities, right? Basically, there are 4 types. A, short term in terms of months, right? B could be medium term, could be months to years, and then the C could be, this longer term, could be, a few years, and then D could even the lifetime investing. You technically can buy and not need to sell at all, as if like property. Who says must buy low, sell high, right? If you look at your own investment, right, whether you're in Singapore, in Malaysia, right, some probably think, hey, Dr. T, my best investment is actually my property I bought like 10 years ago. Did you buy low, sell high? No, Dr. T, I just buy one time and then I forgot I got a house. I just stay, inside there. And looking back, I actually regret I should have bought probably, a few more. Whenever I got money, I should actually buy property. But number one, you may not have the capital to buy so many property. And number two, capital is huge. So therefore, you probably worrying whether that decision is right or wrong. Huh? We are talking about hundreds of thousands of dollars. We are talking about over $1 million kind of investment. But luckily today we got the new this alternative to property. This is called stock market. And the closer to the property market is actually called the property stocks, or more specifically is the REIT, R-E-I-T. Huh? Yeah, so later on this will be one of the highlight in the next subtopic. So think for the winter time, when other people are fearful, as the Warren Buffett says, you need to be greedy. When one day the market actually become greedy, like during summer, become very hot, you want to sell high, I'm not stopping you. You want to actually buy and hold, I'm also all right with that. Huh? So technically, these are the few mechanisms to make money. You can buy low, sell high. You can make money over here. You can buy low, right, and hold long term, not need to sell at all. Also can make money. You can buy and hold and collect dividend. Like just now, earlier speaker talked about, right, the SRT, right, that the REIT, you can collect 5.6% dividend yield. Why not? Okay, but your personality, right, may not able to, right, align with all the strategies. So that's why, including you can buy, for the short term, right, or it may fall down. You can even do short selling. Short selling meaning when the share price actually fall down, you can make money, although that may not be our strong focus for today. But in short, what I'm trying to say is there are hundreds of ways you can make money, but some are more cyclical, more volatile, right? Some are more speculative, some are more defensive. So that's why today, since the market is very uncertain, right? So I specifically focusing on that defensive portfolio, meaning the worst case, the sky fall down, you can still collect your dividend as long as you don't, check the share price every day. Go and scare yourself. Okay, a lot of people, why they miss opportunity is more like their own so-called fear or greed come at the wrong time. Okay, so that's why most people is actually buying high, sell low. Okay, which is a secret to lose money. No need to teach, right? Because by default, okay, this is the nature of the most people. Okay, knowing is one thing, but that's learning together, right? In the next half an hour, exactly how to do so. Okay, if you buy at the lower optimism here, less than 25%, your upside is more than the downside. It's like 75 to 25. It's like you're using $25 to exchange for $75. This is called the risk to reward ratio. Huh? Yeah, so later on, we apply this technique, one of the T55 styles, and the remaining 54 styles, although today I don't have time to cover it, but later on, if we got extra time during the Q&A, I could actually share further. Huh? Okay, so let's look at our next subtopic on market outlook, right? Focusing on Singapore. A lot of people thought must buy many individual stock. Dr. T, tell me I'm prepared to write down a list of the stock to buy. Actually, the easiest way is to buy the entire country. For example, this is 30 STI, right? index component stock. It can give you 3, even up to 4% dividend yield, right? At the same time, you diversify to 30 stocks, including your top 3, DBS, OCBC, and UOB banks. Right? Not enough, we got Wilmar, we got a Singtel. Okay, and that 3 major banks already contribute to 30% of the Singapore STI. But even one day, assuming the sky would fall down, global financial crisis come, they say the 1929 Great Depression may repeat itself. Do you think all the 30 Singapore largest company would all go bankrupt? Think twice before you answer that. Right, Dr. T, I know you will not go bankrupt, but the feeling is not good when the share price would drop by half. Yes, that's why if you can buy lower prices, right, or lower optimism level, that will give you a higher safety margin. But we also don't want to purposely buy low, sell high, and buy low, get lower. We want buy low, sell high, but not to the extent of buy low, get lower. Look at this chart here. This is the optimism for STI. In fact, last time I was invited 2 years ago to give the same talk. You see, in September 2020 during pandemic, looking at this chart from 0 to 100% optimism, you look at the last 20 years, right? 1997, after that, the Asian financial crisis, you can buy low. Year 2000, the dot-com bubble can sell high. Year 2003, SARS and Gulf War to buy low. Year 2007, right, you can sell high. Right, and then 2008, 2009, right, subprime crisis after QE1, you can buy low. Singapore, you can sell in year 2011, 13, or 15. You never sell, no need to sell at all. Wait for the pandemic. Dr. T, how come your techniques seems like you know the future? Frankly speaking, I don't have a crystal ball, but the optimism method, right, is a smart method. It's a probability calculator. Meaning when it's at the low enough, you don't need to buy the lowest. You don't need to sell the highest. You just buy low enough, like along the green line. Or to be more general, you can buy anything below the yellow line. Yellow line is your intrinsic value. Understand? Yeah, so Dr. T, Ein55 intrinsic value over here. In future, you can learn further from Dr. T. Today is just a short presentation, right? But Dr. T already missed it already. Pandemic, I'm so kiasi until every day worry about COVID. So I did not take any action. Fine, good excuse. How about we let the time move 2 years from now? Now move to year 2022. This updated until yesterday, the prices. Okay, this after the Singapore, this is a national day. So optimism is 44%. What does it mean? You are investing $44, exchanging for $56. That's the meaning of optimism. And if you can take action 2 years ago in Singapore STI, protected by 30 largest company, and the worst case, you can get 4% return as if like a bond every year. This is using $24 to exchange for 76. You see, low, they're not buy. And go higher, Dr. T already high, I don't want to buy anymore. But frankly speaking, it still give you discount. Although the discount may not be a lot. Anything less than 50% optimism, yellow line, still got 6% right, optimism discount over here. Don't wait until one day it go above the yellow line. Right? When people not frightening anymore, when everyone back to the stock market, I no need to listen to Dr. T anymore lah. Just show hands to buy lah, because people don't talk about inflation anymore. If that one day come, do you think the market will still wait at the low for you? Probably not. So that's why you need to be different from others. If your competitors, if your friends, your relative, or whoever you do know, they also, understand the same thing as you. They also read the news, okay? And so what is the difference of you from compare with others? So to make big money, in general, you need 2 techniques. Number one, you can actually do average down. For example, when the market dropped to low optimism here, even you do know the lowest is here, starting from the yellow or the green line, you can be like here, 1,000, 1,000, 1,000, 1,000, 1,000, 1,000, 1,000, 1,000. Understand? Yeah, so it means that this technique, the biggest assumption is right, the price would not drop to zero. Right? If you ask yourself, do you think Singapore SCI, or don't need to go for too far? Do you think KLCI Composite Index also got 30 stocks? Do you think Hang Seng Index, which has about 66 stocks? Do you think the S&P 500, which has a 500 business in USA, do you think they all will go bankrupt, will fall to zero? If the answer is not, meaning this is a giant fall down, right? You just need to wait for the giant to recover. And if you do not know the lowest point, it doesn't matter. You can do averaging technique, but remind you, this is not dollar cost averaging. Dollar cost averaging is never care about low and high, buy everything. Right? At the end, your pocket not so deep, you're wasting your money. So that's why a smarter way of averaging is at least less than the yellow line. The good news, Singapore SCI right now is less than yellow line. You want to apply this technique, is possible. You buy at 3,000 points, right? Today is around 3,300, for example. Every 10% fall down, it can be 1,000, right? But how many of you can do that? Because you check a share price, Dr. T dropped 10%, Dr. T dropped 20%. Yeah, that's why 2 years ago, definitely you dare not take action, because this is against human personality. You are too normal. Normal people cannot make big money. Okay, this is for the abnormal person. But you no need to so-called act strong. So you can wait for recovery here. So when the trend is recovering, all right, you can actually gradually average up, no need to average down. Average up meaning while the optimism getting higher, when the trend is getting stronger, right, you accumulate in the uptrend direction. Although you are paying a higher prices, right, but your prices in general moving in the positive trend. It's just your actual return, the yield could be actually lower. Is that okay, everyone? All right, so we continue here. This is more on long term. This probably look at like a 10 to 20 years, right? Every 5 to 10 years, you can buy low, sell high one time if you want to, right? Although right now it's not a perfect time, but currently still at the lower optimism. So in general, this is still a better opportunity, upside more than the downside. How about Dr. T? All right, looking for the medium term. Medium term, every few months you can buy low, sell high. This 1 year ago, okay, actually it dropped to a lower optimism for medium term. Right now, Singapore relatively is a higher optimism. So medium term actually not as attractive, right? Short term wise, he has been bearish for quite a few months, and the good news is recovering above this so-called the resistance. Okay, the resistance which I'm going to share with you right in the next slide, using technical analysis. You can buy SCI right index, but not directly. Right, you can buy like through ES3 ETF. Huh? Yeah, ES3 is one of the two STI ETF you can buy in Singapore. Right, so you'll pay you 2 times dividend payment every year. Right, add up together is around 4%. Huh? It depends on the share price. The higher the price, the yield will be lower. Huh? So so the last few months, yes, a break about 3,200, the resistance, which right now become a support, and even today, yes, break another resistance, which is around 3,003 in Singapore. Okay, whether it can break the 3,004, 3,005, okay, that has to be proven. But at least right now, for Singapore, it back to bull again technically, huh? Yeah, but it doesn't mean the SCI is more suitable for trading right now. We're talking about defensive portfolio today. We are talking about today, even you buy DBS, right, the largest company in Singapore. What if a DBS go bankrupt? We know the probability of DBS Bank go bankrupt as if like Maybank in Malaysia go bankrupt. I'm not saying it's impossible. I just say that probability is so low. Until some people may think probably need to wait for 100 years, not too sure whether it may happen. Even it may happen, you must see who's behind this DBS. Our Akong in the Singapore. Dear Temasek is a major sponsor, major shareholder. Right, today we are not talking about DBS, but later we can talk a few more Temasek related stocks. Okay, right. So understanding your Akong is behind, and what is your confidence level? Dr. T, my only regret is I did not know you 2 years ago. Otherwise, I would apply this method. Every 10 years, like buying property, one round, right? And I will remove all my fear, whether it's called COVID, whether it's called war, everything I don't care. When I see a low optimism, even I don't know the lowest point, I just buy averaging down. Fine. If you can do that, salute to you. But saying is not enough. You must actually do it. So that's why action taking is the most important. Today we're talking about the current situation at here. Not super low, but still relatively low, right? Medium term, short term, and long term. I'll say opportunity in Singapore right now is more for potential short term plus the long term over here, right? So even you do know the lowest point, all right, you can actually doing averaging like through the STI ETF. And recently in August, right, the 3 major banks reporting better result. Why? Because when bank interest rate going higher, the net interest margin or NIM will be increasing. Yeah, so that's why the bank interest income will expand, will be larger. So that one no need to think too far lah, Yeah, but the question is people worry about COVID, people worry about Russia-Ukraine war, people worry about hyperinflation. Okay, yeah, so that's why the fear, right, overtake all this. So that's why the share price in the last few months, right, have a difficulty to go up. So Singapore, in general, to be fair, is still more suitable for value investing. You want to make like big money, through like growth investing, may not be Singapore, right? Unless you go for individual Singapore stock, which is beyond the scope of today's workshop, right? You can actually in future, right, study like global growth stock. Today we're talking about defensive portfolio. So we are using an entire country to defend you. So it means today, in fact, right, this is already one of the possible portfolio, meaning you are not just buying one stock, you're buying a portfolio of stock consists of 30 stock. Even you're limited in capital, you can just buy one this ETF here using index. Is that okay? You don't need to buy 30 stock or every stock 1,000 on it. You just buy one index. If it's not good enough with 4% dividend yield, right, let's move on to the next topic here. Okay, now we move on to the Reits or dividend topic, because Reits, especially in Singapore, right, in general, our government actually can allow the REITs actually to pay higher, right, this dividend, partly because they waive the tax. Right, so one of the condition is they need to return back 90% of the taxable income back to the shareholders in the form of dividend. For example, it's called Capital Mall Trust plus a Capital Commercial Trust right now, it's called CICT. This is the largest REIT in Singapore. The sponsor is actually CapitaLand, and you worry CapitaLand may go bankrupt. Behind is Akong Temasek. Do you think Temasek will go bankrupt? Then look further behind. Who is actually behind Temasek? Okay, at the same time, you're the unit holder. If you invest in CICT, right, you are the shareholder, the trustee representing your interest, and then they'll hire REIT manager, right, to manage the portfolio. These are the shopping malls in Singapore. Tampines Mall, Junction 8. If some of you come to Singapore, you should know it quite well. Now add in the commercial buildings, right? So right now, the retail shopping malls plus the commercial buildings, both combined together can give you around 5% dividend yield. Then they also hire property manager to deal with a daily operation, right? So that's why you are the shareholder, can kill car, no need to actually even ask for money. They can actually deposit the dividend to your bank account. No need to chase your tenants for payment. Right? You are the landlord, except your landlord, you are the 0.00 something % of the landlord. Right? So in general, you no need to spend $1 million, but you must have at least some shares of the REIT, and then you can get return usually 4 times a year. So if you can buy 3 different REITs times 4 payment a year, technically you can have a 12 payments, right? 12 payments if you can align to 12 monthly payment. And one day if your capital plus a dividend yield, right, every month is more than your monthly expenses, technically you can say you're financially free. No need to actually looking for capital gains. Just dividend itself already can, become your retirement fund. But for some of you, it's still a long way to go. Why? Because your capital not enough. Why? Because you did not buy low enough. Because you need to buy low enough to maximize the dividend yield. So this is 30 STI. If you sorted by dividend yield, high to low, for example, dairy farm and the rest. But do not fall into the trap of a value trap. A lot of people, they didn't know, they thought buy the highest dividend yield, then it could be big trouble. You may buy some junk REIT, you may buy some junk so-called dividend stock, which has probably over 10% dividend yield. You buy low, you can get lower, right, for the share prices, right? And then remember, dividend is always based on the past dividend. Past 1 year, right, assuming like Singapore Airlines can pay you dividend, right, before pandemic, but it also means during pandemic can pay you dividend. So that's why this is one of the main concern for dividend investing. You must make sure, right, the company can pay sustainable dividend. So therefore, it must have a sustainable growing business. It must have a defensive business. So that's why REITs in general in Singapore is a good choice. But there are over 30 REITs in Singapore. Not all are good ones. So this is called Reits Index. So this comprising with 30 REITs. If you add up all the REITs, and guess what? You buy everything, and then the REITs can give you this kind of performance. But if you could, I would say better to buy at lower optimism, less than 50%. For example, in year 2007, even you can buy the REITs, it can fall down by actually roughly 70%. You can still lose money, right, if you buy, such a strong portfolio. But if you can combine like an index for the REITs plus buy lower than the yellow line here, meaning less than 50% optimism. For example, in 2008, 2009, it happens before. And then in this year, 2020 pandemic, again, it dropped roughly by 40% one more time. Even as of today, you still got this discount, right? Optimism at the moment is 43%, right? Quite aligned to the Singapore STI. So this is called the sector index, the REIT sector. But you cannot buy the REIT sector as it is. Dividend yield is defined as dividend over the share price. So based on this equation, right, there are 2 ways you can maximize your dividend yield. One is actually looking for company can grow the dividend, or secondly, looking for entry with the share price like here or here. When your share price is the dividend is a constant, divided by share price drop by 40%, 50%, or 70%, it means your yield will be one of the highest, right? But this is theoretically correct, right? If you look back, so many good Singapore REITs actually fell down 2 years ago. Did you pick up a few? Right, Dr. T, I did not. And today, because I see the invitation that you're talking, so that's why I quickly joined. See, want to pick up some stock tips. It's never too late. But even today, I must say that upside more than the downside. But again, you cannot buy the REITs index as it is. You need to find this ETF. Okay, so here, the next one I'll show it to you. If you zoom into here, there's a strong, this REITs ETF. Dr. T would like to present to you. So it's actually listed around roughly 1 year ago. So you can see in the last 1 year, this is like a zoom in of over here. Do you see what I'm saying? Yeah, but because of history is shorter here, we need to actually refer to the REITs ETF here. The alignment of this SLT, this is CSOP Ihs Singapore REIT, which the earlier speaker talked about it. Yeah, so the IPO is probably around like $1, right? Like a bond. Technically, you can view it almost like a bond. Why? You see the volatility very little, up down 5 to 10% the most. In fact, 2 months ago, this one a best opportunity, almost at a 10% discount from $1 down to around 91 cents. Right now, recovered to around 96 cents based on today's price. And if you look at the portfolio, the portfolio is not exactly same as here, but close. The differences is there are big four here. These are the largest four REITs in Singapore. Right. So we got Ascendas REIT, CICT, Mapletree Logistics Trust, and MIT. You see, these are the four all got the something in common called Temasek. Okay, behind got Akong called Temasek. Each one of them is a 10% weightage of the index. Not enough, add in the number 5. Number 5 is called Mapletree, right? Pan Asia Commercial Trust, right? Also roughly 9%. If you add up the top 5, it's already 50% weightage, meaning the 5 stocks contribute to half of the this REIT index. And the best thing is all the 5 are the giant REIT in Singapore. But if you want to buy individually, right, probably say, Dr. T, this one need 1,000, this one need a few $100. Right, some of you, especially those low capital investor, right? Dr. T, I agree. I don't have $1 million, cannot buy property, but I don't even got $1,000. Right? So no more excuses. This is 1 unit. Even the worst case, assuming it come to $1. Worst case meaning you forget to buy, assuming one day go above $1. 1 unit will only $1. Dr. T, may I know how many units minimum I need to buy? I heard in Singapore, one lot is 100 units. Technically correct, but for this particularly SRT REIT ETF is different. In fact, good news for you. Before that is minimum is 10 unit for one lot, meaning you got $10 already can buy. Of course, need to add commission. And I heard from the owner of this ETF here. Right now, the good news, the minimum is same as a US stock. You can even buy 1 unit, but of course, no point to buy 1 unit $1 lah. $1 you make another 100% return is another $1. Then your commission, probably already a few dollars. I'm just saying that, right? Even the worst case scenario, you don't have enough money. For example, you only got a few $100. You should not stop you from investing. Right? We like buy a durian tree, plant a durian tree. Understand? Every month plant 1 durian tree. This month your take home pay $500. Right? Then $500 probably who knows? You can save $100 to buy with a 5.6% dividend yield. Right? If not enough, we got another $100. Can buy just now the so-called the STI ETF. Okay, go and compute that. You got money, Dr. T got 4 more stocks, right, which you may consider. And you can apply average down or average up. For example, assuming you buy at $1, it dropped to 91 cents or 90 cents. Every 10% fall down, you 1,000. You think this one can fall down to $0? You wait for 100 years, not too sure whether it can fall down to $0. It's a giant. Giant meaning it can get injured, but you'll recover one day, understand? And in fact, it's already recovering here. The resistance is 96 cents and today is slightly above 96. So right now, it's not just on the average down, right? You may need to apply possibility of average up. Yeah, so technically right now, the discount is still given to you if you're using a longer term, this Reits ETF over here, right? So for analysis, you use a Reits index, but to take action, you're using the SRT. Okay, is it clear? This is listed in Singapore. It's called CSOP Ihs REIT, SRT. 5.6% dividend yield, but of course, when the price is getting higher, the yield would drop. So that's why for those smart investor, right, the more you fall down, the more they'll buy. But this is only applying for the ETF. You cannot look for individual stock. Some could be junk REIT. Like that, you buy low, it may get lower. So that's why this is like you're buying 20 plus REITs together. This like you have got 50% of your REITs protected by Akong called Temasek. Okay, if you have trust in Temasek, every time it gives you a discount, this is called Great Singapore Sales. By the way, Great Singapore Sale is ending soon. Shopping, in Singapore. But the Great Singapore Sales for the stock still ongoing. Yeah. So sometimes you can look at your personality whether to buy low or to buy high. It doesn't matter. Right. To buy low here, you can look for the support, draw some support. Every time kind of support, you can buy, in batches, or you can wait for the recovery signal, right? For the trend to recover first, which right now is also happening, especially right now, USA is getting more bullish, right? Also leading the Asian stock market become stronger. Dr. T, thank you for sharing 2 index so far, right? ES3, the STI ETF, and the SRT, the Reits ETF. How about for individual dividend stock? Okay, these are the 4, right? Just now we're talking about the big 4 here. So CICT and MIT, right? These 2 will be the 2 I will elaborate further. Right, this is the industrial, this so-called REIT, Right, so technically, nearly half is actually based on the data center. Right, this CICT just already mentioned. Then we got Challenger, which is the electronic retail shops in Singapore, a small company, especially suitable for those small capital investor. Right, if today you're looking for like over 100,000 investment, then don't look at Challenger. It's too small for you. Today you're talking about a few $100s, a few $1,000. This could be ideal, but patience is required. OCBC Bank. Among the 3 banks in Singapore, DBS, OCBC, UOB, OCBC relatively higher dividend yield. It's more undervalued. Optimism level is also lower. So that's why I select that as one of case study. Okay, let's move on to the 4 case studies. Number 1, CICT. Right, since the 10 years ago subprime crisis, 2 years ago you got another low optimism opportunity. Even now it's not low optimism, but I will categorize as a good opportunity. This is one of the big 4 of the SLT, right, ETF just now. So that's why don't play with this stock. 5% dividend yield, upside more than the downside. 32% optimism. You are using $32 to exchange for 68. But the catch is you need to have a lot of patience. Yeah. So of course, if you can wait for this kind of moment, it will be good. But do you want to wait for Dr. T for another 5 or 10 years later? Right. Even you can see me again 5 or 10 years later, I doubt you'll take action. So that's why no need to time the market. Anything less than the yellow line is a good opportunity. But right now, I would agree that CICT, the trend is still bearish. So look at the TA trend over here. This is a support line near to $2. This is actually the resistance over here, the intermediate. So in the last few months, it has been correcting down roughly by 10% or so. So currently, if you are looking for average down, it's possible. For example, if you're entering 2.1 or $2, every 10% fall down, you can be 1,000, 1,000. For example, like here, 1,000, 1,000, 1,000. No need to worry too much. The worst case pandemic already proven to you. Even the shopping malls in Singapore have to close down for probably 2 weeks. Never happened before in the history of Singapore. Still CICT survive. And in fact, the rental income, when it affected, for that pandemic year, right now back to normal already. 5% dividend yield. It's as if you got a printing machine, money printing machine. Every $100 can print $5 for you. Are you happy? We're not talking about capital gains here. There, you see, your capital gains will grow over the years, but there are certain years it could be sideways, it could be bearish. So buying this kind of stock, you need to have patience. If you cannot average down, you can wait for the price to be more bullish. So I'm okay for you to wait for CICT, this price to turn upward first. Right now, it's still bearish, even based on today's price. Is it okay, everyone? All right. So say goodbye to CICT. How about Dr. T, the next big 4 of SLT? The next big 4 is called Mapletree Industrial Trust, MIT. Okay, nowadays they also extend the business to data center. They rent out, they are they are building for the the storage of the data center. So if you're more this online services, so their clients actually demand is more and more. And 1 year ago, they have I think purchased roughly 14 to 16 new data center in USA, and that actually become their new growth engine. Okay, not just based on industrial park and so on. So this is the reason, right? MIT right now, the dividend payment getting higher and higher. And the good news is, even you missed the low optimism 2 years ago, right? Right now, quite near to that 27% optimism. Don't apply like rocket science. Okay, rocket science say, oh, Dr. T, I must buy below the green line. So I must wait for 25% optimism. I must learn from you to buy at this perfect point. No need lah. Anything less than the yellow also already good, right? You are using $27 to exchange for $73. And if you know how good is the MIT, right, and then you know who is behind. There are only 4 Maple3 in Singapore. Now become 3 lah. Maple3 Industrial Trust, Maple3 Logistic, Maple3 Commercial Trust, which combined with the other one, the North Asia, become MPAC and so on. Huh? In future, there might be new Maple3 coming out. Right, but this is actually a proven strong REIT in Singapore. And the best thing, the giant fall down, and the best thing, giant is gradually recovering. Right, but the sad news is you analyze until paralyzed. Right, you still don't know, Dr. T, can you tell me tomorrow will it go higher or lower? Then I say I don't know. I don't have a crystal ball. If you have a crystal ball, can you lend to Dr. T? I'll let you know whether price tomorrow will go higher or lower. So that's why a lot of people want to predict the future. No need. You based on what you know about business, what you know about optimism. Right. In fact, my Dr. T55 styles talking about understanding about the business, the share price, right, and use that to make this so-called take calculator risk to make a decision. Right, even you cannot so-called decide, you can either average down. For example, even assuming you buy $3, right, you drop to 250, you buy another 1,000. 250, if it can drop to $2, you buy another 1,000. Understand? You can average like there 1,000, 1,000, 1,000, 1,000, 1,000, 1,000. Assuming it drop again, then another 1,000. You collect 5.2%, but don't every day monitor the share price fall down lah. Right, now you look at here. No one can guarantee you will not fall down further, but your upside more than downside. This is already protecting you. Is it clear, everyone? Dr. T, I still a bit so-called kiasi. Kiasi one, don't buy low. Kiasi one, please buy higher, average up. Understand? Average up, kiasi. Today we are kiasu. Kiasu means afraid of missing a boat. Then apply the averaging method. Understand? You can also average down plus average up. Combine two together, protected by a defensive business. If you worry MIT may go bankrupt, you worry Singapore no people want to rent the industrial park anymore, you worry Temasek may go bankrupt, fine. In that case, you can actually buy entire Singapore, right, through the STI. You must take one of the action. Right, today you do all kind of analysis, you can attend 100 different talks, but at the end you got 0 action. Your result is still 0. Your $100 is safe in your bank, but your $100 forever is still $100. The worst thing, right? Inflation will erode your return. Your $100 next year will become $95 because inflation is like 5%. Is that clear? Right. So Dr. T, I finally understand what I'm talking about. Right. There's no free lunch. Each of us, we are fighting against the uncertainty of the future. But if we understand all this hidden, right, opportunity given to us, if we can take calculated risk, right, that will be best for us. Okay, now we move on to the next two, which are non-REITs. One is the one of three major bank called OCBC. Look at the last 20, 30 years. If you can follow Optimism, year 2000 dot-com bubble to sell, right, year 203 SARS and Gulf War to buy, 207 can sell. 2829 subprime crisis can buy. 2011 can sell. Right, although this one nearly hit low optimism, have not hit. There's still a relatively good buy. Then 2018 a sell. Pandemic a buy again. Yeah, in fact, Dr. T went graduate, right, considering this OCBC Bank around $8 plus. $8 until here, capital gains $12 already 50%, plus 4 to 5% dividend yield every year. Right? Why need to analyze until paralyzed? Right? Can you close one eye? 47% optimism still give discount, but DBS, UOB, both of them do not give you the discount. OCBC Bank still give you the discount. Among the three banks, this is the highest yield, 4.3%. But right now, with interest income getting higher, likely the payment will become more and more. Huh? Yeah, in fact, recently, I think just a few days ago, right, they're announcing better result. Among the three banks in Singapore, OCBC, the growth is the strongest. Okay, so far, huh? Okay, but we are talking about investing over here, meaning you need patience. We are not talking about weeks or months. Okay, right. So look at technical analysis. The share price not only supported around $11, and even today the share price is around 12.4 something. I almost want to break the 12.5 resistance here, meaning this stock you want to do trading also can, not just for long-term investing. Although we are talking about today about creating a defensive portfolio, you can use the STI ETF, you can use the SRT ETF, you can use the MIT using the CICT, you can use the OCBC Bank, plus this challenger. Already got 6 stocks. Not enough? Later on, Dr. T will give you a chance to learn further from Dr. T. Huh? Okay, so come to here, challenger. Right. For those of you, if you don't come to Singapore, may not know about challenger, selling electronic stuff. Okay, so during pandemic, right, the sales even better. And during pandemic, it dropped to low optimism. Great opportunity. Even at now, still a low optimism. But the share price has already gone up probably by maybe another 50%, right? But currently, if I can zoom in to this portion, this is actually an excellent opportunity for whoever patient, right? It can give you 5.2% dividend yield. It's now forming, we call it the ascending triangle. Okay, you see the higher low. Recently, a few days ago, it dropped to around 53 cents. Right, but it's aiming to break the 60 cent resistance. It may go like that, for the next few months. So you have 2 ways. You can buy near to the support here. Every time come to support here, you can average down, or you can actually wait until it breaks 60 cent, like 61 or 62 when you enter. But of course, at 61, 62 cent, your yield may drop to like 4% only. Huh? Is that clear? Yeah, but this stock has a few limitations. Number one, this is a small cap. Number two, the public float is limited, right? Because the majority shareholder, like the Lu family, right? The big four, right? They're controlling almost like 80% of the shares. Roughly 3 years ago, they tried to delist Challenger, but because of one like Pangolin Fund, tried to stop it. At the end, missed by a few percent of the support, so could not delist it. Right. So right now, they may not be so generous to pay dividend. Okay, although the company still make good profits. Yeah, so but if they are reluctant to pay dividend, right, not to worry. A lot of people thought dividend stock must pay a lot of dividend. Not quite. They can retain their earnings, but then it will become a growth stock. Okay, but if you are looking for longer term investing, this stock, although I would say the potential of delisting is also there, but since it failed 3 years ago, it will take times. Okay. Yeah. So if you're okay to collect, may not be 5.2%, assuming they may cut down on dividend despite making money, assuming to 4%. Are you okay with 4% dividend yield? Or depends on you. So you add up all the 6 stocks we mentioned early on. In average 4 to 5% dividend yield. It may be a roughly 5% dividend yield. Are you okay to have a portfolio? Although I cannot say cannot lose money. You may have some capital loss at a certain point of time when the price is bearish. But more importantly, this can form some of defenders. In future, you can learn further from Dr. T, like how to form like these defenders, midfielders, and strikers. Okay, just for whoever want to learn further from Dr. T, you can go to Investing Note to connect to Dr. T, right? And then you can also visit my website, Ein55.com, to download free 2 ebooks from here. I can learn further, because today I can only have time to cover this so-called the dividend investing. For example, you go to the Investing Note website. Yeah, this is you can click like follow here, right? Then these are my articles. Every few weeks, I'll write some articles like defensive stock, undervalued stock, right? The impact of inflation and so on. Okay, right. At the same time, right, you can actually also download the 2 ebooks from my website, Ein55.com here. Okay, so my plan this way, I will open up for Q&A. Right, and thank you for all your attention. Thank you.
Thank you so much, Dr. T, for your sharing. All right, so let me pull up my screen. Okay, so thank you so much, Dr. T, for your sharing. Happy to actually learn from you always. Thanks for giving your insights about the current stock market and also sharing your views on how to build a defensive portfolio with an index ETF and also the 4 gigantic stocks, which I believe our participants wouldn't really want to miss out. So participants, if you have any questions who would like to ask the speakers, do drop your questions in the Q&A box, as we'll be having a Q&A session right now. So I think we have a few questions inside the Q&A box. So let's take a look on the first one by Mr. Anonymous. So given the market situation, do you think it's a good time to invest in the low price, or do you think this will be a prolonged downtrend? So I think, Dr. T, you mentioned about this just now, right?
Raphael also can share a view, but technically, as Dr. T mentioned earlier on, no one would know the future. Yeah, you ask this question, likely you're afraid of market is bearish. So this is the reason today I specifically prepared this topic here. Whether you are kiasu or kiasi, doesn't matter. Important is actually you must adopt one of the strategy, right, suitable for you. But even you are kiasi, not to worry. Right now we may have seen some light at the end of the tunnel. So USA also recovering, although Hong Kong side still getting bearish, right? For Singapore, all the while has been quite stable, right? So that's why for Reits, right, like just I mentioned, the SLT, all these are variable investing, and you sometimes no need to look for perfect timing. Wow, Dr. T, tell me the lowest point. If I know the lowest point, definitely I'll buy already. I'll buy $10 million. Okay, but exactly no one would know, right? To be frank to you, even Warren Buffett, the same thing. Aga, right? Enough knowing where is a low enough is good enough. So that's why Warren Buffett always says, when other people are fearful, you need to be greedy. Then you probably twist your question, Dr. T, are we greedy or fearful now? Now I'll say a good, perfect balance right now.
Yeah.
Whoever has been fearful, right, they have sold their stock, until now. But whoever want to be greedy, I would say you need probably pay more attention in the next few weeks because there's potential of bottom fishing. But if you want to have a good balance between the growth and dividend investing, I'll say just now the few stocks mentioning, including the SLT ETF, will be a very good choice. Okay, Rafa, anything you want to add?
Oh, okay. Thank you, Dr. T, for sharing. Okay, so basically, yeah, given the market situation, do you think it's a good time to invest in a low price? I think for these kind of questions, what does a low price, I think, mean to you? For right now, you need to ask yourself is that what do you think a low price mean to you? And if current valuations are within your expectations, then I think you need to justify that, and why do you think that it is worth your money to invest in. And I think for this current juncture is to keep an eye out of asset classes that tend to overgear, because with rising interest rate environment, cost of capital is going to be higher. Then higher gearing would set the company into some financial trouble in the future, if let's say they do not break in the same revenue. So I think this is something you need to consider. So what does a low price mean to you? If it's current valuations seems fair to you, then I think it's always good to diversify out and to enter in trenches rather than to one shot and try to fish for the bottom. We never know the bottom. Like Dr. T mentioned, if we have crystal ball, I think it will all be nice and all, but I don't think we have the crystal ball to see what's going on in the future. So it's always good to diversify out, space out your investment in this current environment.
Okay,
Uh,
thank you so much. Yeah, Dr. T, you have anything to
Probably
add on?
to add on to Raphael sharing lah. Despite having said all this, it's still useful, for example, for the audience to apply some form of a trend analysis. For example, like technical analysis. For example, like optimism just now. Although no one knows the lowest point or the highest point, but it can tell you relatively low enough. Right? For example, if you understand right now the Reits in general still got discount given to you, it means your upside more than downside. Your probability is higher. Okay. Yeah. Unless today you're talking about pure trading. Pure trading in that case, your technical analysis, yeah, your ability to handle or even to possible to even stop loss. Right. We're talking about possible, if you're loss of like 5%, 10%, will you cut loss? Okay. Some investor they will not think of a cut loss. They'll just say buy a portfolio of stock and let the time smoothen the trend. Because stock market in the short term, we call it voting machine, up, down, up, down. But stock market in the mid-term to long term is a weighing machine. Yeah, so that's why it all depends on you.
Okay, thank you so much, Dr. T. So I think the next two questions will be directed to Raphael. So one of the anonymous attendee was asking, what's your view on the current interest rate hike? Do you think that the Fed will continue to raise until the market starting to slow down?
Okay. For this question wise, I don't think the Fed will want to kill the market. Just put it simply in perspective, the central banks, they have certain goals to meet. So first off, the purpose of a central bank is to first off keep prices stable, keep inflation in check, and last but not least, focus on employment data and employment rate. So with this current environment that we are seeing, employment is doing relatively well in US, then you can understand where the Fed is coming from when it comes down to raising the interest rate because of the unstable prices and the red hot inflation. So these are the things that they have to balance out to make do with it. I don't think that they would want to purposefully raise the rates to kill off the market, but at the end of the day, they want to just keep the prices stable and keep inflation in check.
Okay, thank you so much. The next question will be, hi, which website should I go to get more info about Reits?
I think most investors, you can refer to reports from CBRE. They are a independent property research company. So just Google CBRE, and likelihood you'll be able to find reports from the various sectors of the REITs. I understand that some things I'm not able to comment or share here, but then again, for if let's say you're looking at the Reits Index itself, the Ihs Leaders Index itself, just proceed on to SGX website.
Okay, thank you so much. All right, so the next question from BH Core. So can you comment on difference between SRT and CLR in terms of the portfolio mix and strategy? What's the dividend frequency of SRT?
Okay, I cannot talk about product, but just for information, the SRT and CLR itself, difference is that the methodology. For SR, I cannot comment for CLR, but for SRT, it follows the Reits Leaders Index. So the Reits Leaders Index, what they do is that the beauty of this index is that it rebalances according to liquidity adjustment. Like I shared earlier on, liquidity adjustment, it meaning to say that it will record the daily trading velocity of the underlying REITs itself. And if let's say investors like you and I, we tend to participate in the market, but most of us, how many of us can actually move the market? We based on our small quantum of investment, right? So usually when market moves and velocity change is due to institutional movement, fund flows, sector rotation that moves the market. And with this liquidity balancing, it just means that investor themselves will be able to keep up with the current market trends. If let's say funds flow from industrial sector to maybe to office sector or to retail to hospitality, the rebalancing works based on the liquidity adjustment. So for this SRT itself follows Ihs Leaders Index to replicate it. So I cannot comment for CLR, just that I would say that both they use different methodology in terms of the index tracking.
All right, thank you so much. Okay, another question is directed to Dr. T. So how do you determine optimism indicator?
Okay, Optimism, I suggest you in future, probably, you can drop by my website, Ein55.com to learn further, right? Because today got limited time on the trading. But technically, Optimism, the idea is to define the value. Once you know the value, then you can know the prices, the low and high. But remember, this is just one form of valuation, right? There are others you need to consider, like macroeconomic condition, right? For example, the technical analysis, for example, the business analysis, the fundamental analysis. And the other one I did not mention is called level analysis. Level analysis meaning your individual stock, for example, just now, the Singapore Reits, they are affected by the sector. Right. For example, today, Singapore, most of the REITs in Singapore today are going up, including SLT also going up. Why? Because SLT representing the level 2, the sector, but they also aligning to level 3, the country. So that's why today STI is also going higher, and they all align to the level 4. Level 4 technically means the world index. Right. For example, last time you see the S&P, the Nasdaq going higher, nearly 2% go higher. Why? Because of the good news, right? The inflation dropping. And remember, we are reading all the past news, all are outdated. Stock market is forward looking. When pandemic comes, people already plan pandemic would end. When pandemic end, people looking for inflation, come to a new high. When inflation come new high, people already see it fall down. Everything is 6 months ahead. So you cannot just read the current news. That is insufficient. So that's why, frankly speaking, right now could be one of the very good opportunity for some planning for do bottom fishing, especially related to the next question by the audience about Hang Seng.
Okay, thank you so much, Dr. T. So let's come to the last question by A Lai. What's your opinion on buying the Hang Seng Index ETF and China A50 ETF now? So I think this question will be more towards open. Both of you can give your opinion on this.
Probably I can share a bit on that because recently, in the last half a year, right, you got chance can drop by Dr. T, the blog, can learn further, right? The Hang Seng indeed right now at low optimism. If you have missed Singapore STI 2 years ago, you have 100 reasons. Dr. T, I worry about pandemic. I dare not do any investing. Fine. Are you scared right now on COVID? If not, right now, Hang Seng almost a similar situation as Singapore 2 years ago. Hang Seng, even I think yesterday dropped below 20,000 points. Today go up a bit, And but you need to understand why Hang Seng is so volatile. Just like I mentioned, right, the 30 STI, 3 banks in Singapore affect 30%. Similarly, the ATM machine, Alibaba, Tencent, Meituan, the 3 stock actually affecting, right, 30% of the 66 Hang Seng component stocks. And nowadays, due to the US and China trade war, some worrying like Alibaba may be forced to be delisted from this US side, And even this SoftBank sell down on this Baba, but still making money. But what I'm trying to say here is this is no longer a stock. This is actually come to even political level. It means it become more uncertain. But today, you ask yourself, do you think Alibaba may go bankrupt? Assuming yes, assuming everyone want Alibaba to die, right? They say China want to get rid of Alibaba. US also want to get rid. Assuming in future no more Alibaba, but that Alibaba only affecting 10% of the Hang Seng. Assuming you buy $100, Of course, Hang Seng cannot be so cheap, $100. Assuming you buy $100, even 10% is gone. You still got $90. And just now the other question is to compare with A50. A50 and Hang Seng, I would say Hang Seng is even more attractive than the A50. Okay, yeah, or some of you want to look for CSI 300 also can. Yeah, but China right now, I would say a little bit more in the some political, I would say some political issue, especially the fighting with Taiwan, with US side. So currently, I'll say for trading may not be so suitable. But if let's say from investing perspective, I would say the Hang Seng likely is a better opportunity than the China side. Okay, partly because the optimism is lower, more attractive, and partly because Hang Seng, they are more established businesses. Although China is a bigger region than the Hong Kong, but in fact Hong Kong stock exchange is more established than China. Yeah, so that's why for foreigner, in fact, investing in Hang Seng, probably you feel safer than investing in China directly. Although, probably 10 or 20 years from now, both could be doing well. Okay, yeah, that's all my view.
Okay, thank you, Dr. T. Raphael, do you have anything to add on?
Not really. So I think for that question, right, for the particular investor, I think for right now, keep an eye out on the valuation. If you think based on your justification of this valuation that you think that is cheap, perhaps it maybe it's price to book valuations or it's PE valuation. So the PE of Hang Seng also came down quite a bit. So I think at this juncture it may be seemingly attractive, but it is really depending on your individual perspective on how cheap is cheap, because we never know when is the bottom. So what I can just give a piece of advice or two is just that keep an eye out. If you think that it is within your expectations, then I mean, why not go ahead? And if not, you can just space out investments, which is why ETFs always provide, I would say, investors a chance to participate in market trends and market movement without having the need to focus on one single particular stock or to get yourself into the risk of concentrational risk. So just leave it as such. If you think that it's cheap, then by all means go ahead. If you think not, then you can just wait out. I don't think there is any harm at this juncture. Just keep an eye out.
Okay, thank you so much, Raphael, for your view. All right, so we have come to an end to our webinar. Thank you so much, Raphael, and also Dr. T. Both of your sharing is very, very interesting. So I believe all of our audience at here has a clearer picture on how to on what are the things that we should look up going forward, and also how to actually build a defensive portfolio. So yeah, so if you are interested to invest in Singapore market, you can actually head out to every of the brokers at here, or just straight away scan the QR codes at here and to contact to your reminder or dealer, can straight away open up the overseas market, especially for Singapore market. So last but not least, we have two QR codes at here. Once again, we have the Sjx Investor resource, which actually they design and also develop the tools and techniques that all investors from newbie to professional needs to make an informed investment decision. So this is a strong tool for you to do your own research when you are searching for some of the equities and also the products. And next, we also have the Sjx Telegram, which you will be the first few to get the daily market reports, research on certain Singapore stocks, the latest news on specific stocks, and also fresh updates every day. So last but not least, we are Investing Note, which connects the investor for better investing outcome. So we are a platform and also a community, largest community in Singapore. So we also provide many of the free features, including community calendars, portfolio insights. If you want to take a look on the charts, it's also free. Price and also alerts for certain stocks that you are interested in. So thank you so much, Dr. T and also Raphael, and thanks to all of the audience at here. So we have come to an end for this webinar session. We'll see you in the next session. Thank you.
All right. Thanks, Dr. T. Thanks, Investing Note.
Bye-bye.
All right.
Thank you. Bye bye.